Welcome to our eSignal Weekly Forex and Futures Forecast. My name is Jay Norris. Happy New Year. First market we're going to take a look at is the Australian US dollar. We talked about the Australian dollar 2 weeks ago before we took the holiday break. We talked about what an important level that was. Price couldn't even get down to it really to probe it, and you had a bounce out of that area. You had a nice rally. We like that. We talked about taking advantage of that as a short-term trader. That was good stuff. On the other hand, you still have that primary pattern down. If you look at our ratio there, yes, all those short-term patterns are up, but the primary pattern is down. Now, generally, with all those patterns up, yeah, we're still looking to buy dips short-term. On the other hand, you're right below long-term resistance. For us, really, the time when long-term resistance is significant is when you're at it. That's when it's most relevant. You are at it. The thing to remember about the Australian dollar is that it's a commodity currency, and there's still plenty of players out there, traders out there that believe that, and also it's a proxy for the Chinese economy. Chinese economy making headlines lately. You had that frightening manufacturing number. And as long as you have fear coming out of China, as long as you don't have positive growth coming out of China, you have that primary pattern down. That's a tough row to hoe. So from a long-term perspective, definitely avoid that market from an investment standpoint, particularly when you're right below significant resistance like that. Continue to monitor it as a short-term trader. We could shift on the short side pretty quickly too as those shorter-term patterns roll over. I should say if they roll over against that long-term resistance. So that's how I view the Aussie right now. Dollar Swiss. Talked about this market as well a couple weeks ago. Love it on the upside. I love it as a long-term investment. You can see it came to life here right at the end of the year. You had a nice rally. From both a short-term perspective and a long-term perspective, we're buying dips in this market. You can see there's some resistance up above that 25-day pattern. Certainly that's a significant pattern. On the other hand, it's just one pattern. When you look at all the rest of them, they're decidedly up. They're bullish. So here's a market where I appreciate it because both long-term and short-term, you're buying dips in this market, both long-term and short-term. It's a bullish market, and we call this market the trade of the decade when it broke out down in here, and we still see it that way. Take a refresher here, look at a monthly chart on that guy, and boy, look at this. Put some trend lines on there. There we go, and look at the potential breakout we have in this market. Really a sea change move in the making. So we love dollar Swiss. Essentially, we love short the Swiss franc. We love being long the dollar against the Swiss franc. We think there's just a ton of room up above in the market. And you see all those long-term patterns higher. And you see the short-term patterns shifting in line with those long-term patterns. So pretty bullish setup in the dollar Swiss. Next market, the dollar index. Here's the daily chart of the dollar index. You can see that market just starting to break out, closing, getting a nice close above that trend line on the last trading day of 2015. Pretty good year 2015 for us. We really focus on those short-term patterns. We do well with them with our methodologies. We're focusing on a little bit higher time frame too. We've been working on that study, and I'll show you what I'm referring to there when we get to the euro chart. But dollar index right now, interestingly, the 10-day is still holding down. On the dollar Swiss, we just looked at the 10 days up. The euro, we're going to look at next to 10 days down. However, the dollar itself, the 10 days down here. So market just kind of in a holding pattern, pausing. Wouldn't take much higher price action to switch that 10-day. And when it does shift, that's going to be a bullish factor for us because then it puts the majority of your short-term patterns, the 5, 10, and 25, the majority of those would be up, 2 out of 3 up. That means we're buying dips short-term. You've already got the higher time frames, the 50 secondary primary, they're up. So there you go. We don't need any encouragement on the upside there. You guys that have been with us for some time, or perhaps you've just you follow us on our weekly comments here, we've been bulled up on the dollar for a long time, and that's not going to change from our perspective. No one else in the global economy can really rely on that huge retail market, the retail spending that the U.S. has, and that's going to be the big difference going forward. That and higher interest rates too, and we'll get to that also. Next market, the euro. Here's the euro. That 10-day pattern shifted lower on the last trading day of the year right there. Almost slipped by us. I was watching football and eating hamburgers, and it wasn't until I pulled up the charts today that I saw, oh yeah, the last day of the year, that was significant. They shifted it down. It's still in a bit of a holding pattern there, and you can see it. You have 25-day support right there. Market bottomed on there. You actually had a double bottom on that before. Here's your first bottom right there. Then your second bottom. That provided a nice buy signal for us. based on that 25-day pattern. On the other hand, though, nothing going on now. You shifted some short-term patterns higher, then you shifted them lower. So I think overall you're at a bit of a holding pattern here. But longer term, you have to focus on the primary, the secondary, the 50-day. They're all down. Tough sledding there. Well, now that the 5 and 10 are down also, we're bears short-term, we're bears long-term. That's about all we can say for that market. So Euro, we look for more of the same. I made that reference before to what we're doing as swing traders, what we've been working on. Here's essentially our swings trading strategy, and that's based on the 4-hour chart, that 240-minute chart. So pretty good performance. And what I love about our swing trading performance, a little bit longer term view of the market, is that it's actually even more simple than how we approach the short term. Short term, it's a combination of the patterns we're seeing, where on the intermediate term, it's just one pattern. It's a standalone pattern, so a lot easier to track along with that. Less is more for us. We like to keep it simple. Really nice performance. So that'll be something that the signals as they come up in our swing trading method will be something we'll cover more in our weekly reports. But for now, we're selling rallies both short term and long term in the euro in anticipation of continued lower prices. Gold's down on all time frame patterns. I think you have to really get a view of this market, you have to look at it long term, and there you see it. A lot of room below. We think it's going to just above 800. That'll be our long-term target for that guy. So a lot of room down below. We see gold as a market you definitely want to avoid as an investor. Next market, U.S. interest rates. First market we'll cover will be the U.S. 10-year note futures. Note futures, you can see interest rates have been low for a long time. Interest rates, by the way, have an inverse proportion with their price. So as the note futures rallied, this is a monthly chart too. So as note futures rallied from 2007 on into 2013, that meant interest rates were going lower, 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 lower. Now we're finally seeing the notes reversing. You're seeing higher interest rates in the United States. And here's what I wanted to point out. Look at that monthly trend line break. Now, that's a fact-based occurrence. The monthly chart closed above that long-term trend line. When I say fact-based, it can't go back up there because that monthly candles, that's it. That's December 2016. It closed the year below the trend line. We see that as a pretty powerful signal that you're going to see downside in U.S. Treasuries, i.e. upside in U.S. interest rates. Let's even simplify that further and look at just the interest rate chart. That's a longer term chart. We'll go to the weekly chart. There's the weekly chart, U.S. interest rates, and you can see on a ratio, you've got all the patterns higher, right? So your average person looks at that chart and say, well, you're in congestion. Keep in mind this is a weekly chart. Well, you may be in congestion here, but on the other hand, all our patterns are aligned bullish. So we see a lot more upside here for 10-year U.S. interest rates. I think we threw out 3% last time we were together 2 weeks ago. I said 280 initially, and I revised it. Hey, as long as you're headed to 280, as long as you have a breakout above 2.5 here, you're probably going to see 3. So I'll stick with that. That's definitely going to be supportive of our dollar bullish theme. Again, the combination of a strong retail economy coupled with higher interest rates, meaning investors are getting paid more money, U.S. savers are going to be getting paid more money going forward. That's going to be supportive for the U.S. dollar, and that's why long-term we're dollar bulls. Thank you so much. My name is Jay Norris. I teach trading at Trading University, and we'll see you next week.